Today I answer questions asked by our viewers, and if you have one, please leave a comment below. Otherwise, let's jump in. And the first question comes from Massimiliano asking, can I get equity from a property owned outright? And that's a great question. Now, the short answer is absolutely you can, providing the security is acceptable to the bank. But the long answer is that with banks, they're always looking at loan to value ratios. If we have a property worth $100,000, the bank is willing to bring that up to 80% of its value. And that's based on the valuation the bank provides. So providing the valuation comes in at $100,000, the bank can lend you $80,000 or 80% of the value of the property, even though it's owned outright. All they'll do is they'll transfer the title in both your and their name, so there'll be the registered mortgage against the property. And because you own the property outright, the bank may ask you some questions about what you're using the money for, and each lender is different. So some banks will actually want evidence once it's over a certain amount, typically $50,000, and other banks, providing it makes sense, will be completely fine for it. The next question comes from Stevie, and he asks, can you use your family home as a deposit for a new home? And going back to the equity, it's all about how much your property is worth versus the debt outstanding. So let's say you have a family home, and let's say it's worth $1 million. And if you have $500,000 owing against the property, remembering that you can take that up to 80% without mortgage insurance. So that would mean that you could potentially leverage another $300,000. And that $300,000 could go towards your next purchase. So if you're purchasing for an investment property for $500,000, that could go towards a 20% deposit, plus any additional costs such as renovations or stamp duty. So in short, providing you have equity, you can use your family home to fund the purchase of your next home. Andrew asks, what complications do you meet with the banks applying for a loan for building an off-the-grid property? The majority of lenders will want you to be connected to the main water and electricity and all the rest. So this is a real trouble for most providers. However, the good news is there's one or two lenders that'll actually consider this, providing it makes sense. So for example, you'll need to have solar, you'll need to have a septic tank, and all the rest of it, providing it makes sense, or a water tank, then the bank can consider up to 80%. And this is becoming more and more common as a push for renewables and sustainability is happening. So if you are looking to build a property off the grid, there definitely are lenders out there that can help. However, you'll need a minimum 20% and it has to make sense. So just think about all the things that you'll need. Stevie's got another question here asking, what do you look for in a mortgage broker? Firstly, here are 5 questions you can ask your mortgage broker just so that you understand who he or she is. And the first one is, how many years experience do you have? This is important. You don't want someone that's new to industry, because ultimately you want someone that knows the landscape, that can really push you forward and really guide you if and when the times get tough. The next question to ask is, what type of clients do you help with? And do you have any recent examples? You want to know that they're very familiar with your specific circumstance. So if you're a first-time buyer, how many other first-time buyers have you helped? And can you give me any recent example of how you specifically help them? From there, you'll ask, how can you help me after I buy this home? And what you're looking for here is what their review process is post-settlement. Are they checking in with you? Are they making sure your rate's still competitive? The next question is, who owns your aggregator, and are there any conflicts of interest? And the final question is, what qualifications and accreditations do you have, and are you industry recognized? And the other thing you can do is Google them to see what type of reviews they have online and whether or not they're actually legit. So there's a few things you can do there just to make sure that you're going to choose a right mortgage broker. The next question comes from Kim, and she asks, can I borrow extra on my mortgage for furniture? And providing you have equity, as we've discussed before, you absolutely can. The only trouble is if you purchase a property for say $500,000, even if the valuation comes in higher, then the bank will take the lower of the two, either the lower of the valuation or the lower of the purchase price. So it means that you may not have instant equity, and it may not be something you can borrow for, particularly if you're borrowing to your maximum when you're purchasing a property. Jared's question is, can you borrow a deposit for a home loan? And you can, providing you have equity. Now, the equity doesn't necessarily have to come from a property you own. A guarantor home loan is using the equity from another person's property. Typically, that's your parents, and it allows you to essentially borrow 100% of the property purchase price. So you can borrow for the deposit. However, you can't use a car loan or anything else these days. This was something that you previously could do quite some number of years ago, but no longer that's the case. But providing the loan comes from a securitized mortgage, then you can absolutely use those funds. Alex wants to know, what is appreciation or depreciation of the property? Appreciation is where your home increases in value. It appreciates, whereas depreciation is the opposite. Depreciation is where the property decreases in value. And the final question we have for today is coming from Blake, and he's asking, what is a honeymoon rate and a honeymoon period? A honeymoon rate is a variable home loan rate with a high discount. So let's say the reference rate is 6% and you have a 3% discount. That discount will typically only last for a short period of time. Typically, it's between 1 and 3 years. After that, the discount will decrease significantly. So say instead of getting a 3% discount, you bring it down to 2%, the variable rate increases too, and you'll be paying a higher interest rate there on forward. Now, it's not to be confused with the fixed rate. The honeymoon rate is fully variable and will increase and decrease as the rates increase and decrease also. Short term, it's a really phenomenal product because typically you'll get a higher discount and lower interest rate than any other product. But what the banks are trying to do is get you comfortable so that after the honeymoon period ends, that you're paying a higher interest rate and they reap higher profits. Here at Hunter Galloway, we get home loans approved. So if you're looking for a mortgage broker and live in Australia, we can help. We don't charge a fee for our service and we help Australia wide. So reach out and visit us on huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and until next time, I'll catch you then.